Today, we will talk about the 183-day rule, definition, how it's used for residency, and example. The 183-day rule is used by most countries to determine if someone should be considered a resident for tax purposes. In the U.S., the Internal Revenue Service uses 183 days as a threshold in the substantial presence test, which determines whether people who are neither U.S. citizens nor permanent residents should still be considered residents for taxation. The 183rd day of the year marks a majority of the days in a year, and for this reason countries around the world use the 183-day threshold to broadly determine whether to tax someone as a resident. These include Canada, Australia, and the United Kingdom, for example. Generally, this means that if you spent 183 days or more in the country during a given year, you are considered a tax resident for that year. Each nation subject to the 183-day rule has its own criteria for considering someone a tax resident. Some countries have even lower thresholds for residency. For example, Switzerland considers you a tax resident if you have spent more than 90 days there. The IRS uses a more complicated formula to reach 183 days and determine whether someone passes the substantial presence test. To pass the test, and thus be subject to U.S. taxes, the person in question must. Strictly speaking, the 183-day rule does not apply to U.S. citizens and permanent residents. U.S. citizens are required to file tax returns regardless of their country of residence or the source of their income. However, they may exclude at least part of their overseas earned income from taxation provided they meet a physical presence test in the foreign country and paid taxes there. The U.S. has tax treaties with other countries to determine jurisdiction for income tax purposes and to avoid double taxation of their citizens. These agreements contain provisions for the resolution of conflicting claims of residence. The IRS considers you a U.S. resident if you were physically present in the U.S. on at least 31 days of the current year and 183 days during a 3-year period. The 3-year period consists of the current year and the prior 2 years. The 183-day rule includes all the days present in the current year, 1/3 of the days you were present in year 2, and 1/6 of the days you were present in year 1. Many states use the 183-day rule to determine residency for tax purposes, and what constitutes a day varies among states. For most countries that apply this rule, you are a tax resident of that country if you spend 183 or more there. The United States, however, has additional criteria for applying the 183 rule. If you meet the IRS criteria for being qualified as a resident for tax purposes and none of the qualified exceptions apply, you are a U.S. resident. It is important to consult the laws of the country for which the test will be performed. If wanting to find out about meeting the U.S.'s substantial presence test, you must consider the number of days present within the last 3 years. Here are 5 key takeaways. 1. The 183-day rule refers to criteria used by many countries to determine if they should tax someone as a resident. 2. The 183rd day marks the majority of the year. 3. The U.S. Internal Revenue Service uses a more complicated formula, including a portion of days from the previous 2 years as well as the current year. 4. The U.S. has treaties with other countries concerning what taxes are required and to whom, as well as what exemptions apply, if any. 5. U.S. citizens and residents may exclude up to $108,700 of their foreign earned income in 2021 if they meet the physical presence test and paid taxes in the foreign country. Hope this would help. Thanks for watching.